Why millions fear running out of money, and how to stop living in fear. Consider dedicating your entire life to work. You wake up early. You commute. You save money. You pay bills. You invest what you can. You dream about retirement. One day, someone asks you a straightforward question. What are you most afraid of, dying or running out of money? Many assume the answer is obvious, dying. But according to a recent survey, 67% of Americans say they fear running out of money more than death itself. This is worth considering. More people fear financial insecurity than death. That is not just a financial statistic. This serves as a psychological warning. It also highlights how modern society views money. Today, we'll examine why this fear is so widespread. We'll also discuss why it affects both Canadians and Americans. Most importantly, we will outline how you can significantly reduce this fear, regardless of your current financial situation. Financial peace is not reserved for millionaires. It is available to anyone with a plan. Most people think they fear losing money, but that's not entirely true. Money itself is simply paper, numbers on a screen, or digits in a bank account. What people truly fear is what happens when money disappears. They fear losing their home. They fear becoming dependent on their children. They fear not being able to afford healthcare. They fear losing their independence. They fear being forced to work long after they are physically exhausted. In other words, people are not afraid of money. They are afraid of losing control. And when you understand that, everything changes. Because financial planning is not really about money. It is about creating certainty. The world feels more uncertain today than it did for previous generations. Housing costs have exploded. Food prices have increased. Healthcare expenses continue to rise. Interest rates change. Markets move up and down. Headlines constantly tell us something terrible is coming. Every day, people are exposed to a stream of financial anxiety, recession, inflation, debt, housing bubbles, stock market crashes, economic uncertainty. Eventually, people begin to believe that financial disaster is unavoidable. But here's the truth. The biggest threat is often not the economy. The biggest threat is uncertainty. Because uncertainty creates fear, and fear creates poor decisions. His may come as a surprise. Many people are saving money. However, many are unsure of the purpose their savings serve. They contribute to retirement accounts. They invest in ETFs. They buy stocks. They build savings. However, if asked, how much income will your portfolio generate? Most are unsure. If you ask, how much money can you safely spend each year? Most are unsure. If you ask, what happens if the market falls 30% after you retire? Most are unsure. This uncertainty often leads to fear. Uncertainty frequently causes anxiety. Consider boarding an airplane only to learn the pilot has no flight plan. You would likely feel uneasy. Similarly, millions approach retirement without a clear financial plan. Fortunately, fear can often be significantly reduced by taking one simple step. Develop a written financial plan. This does not require a lengthy or complex document. A straightforward plan is sufficient. What do you own? What do you owe? What income will you receive? How much do you spend? How much income will you need in retirement? What happens if markets decline? Writing down these answers has a significant impact. Uncertainty begins to diminish. You stop guessing. You stop worrying. You start understanding. And understanding creates confidence. Stop thinking like an investor. Start thinking like a retiree. Most people focus on portfolio size. They say, I have $300,000. I have $500,000. I have $1 million. But retirement is not about having a portfolio. Retirement is about generating income. Let's compare two people. Person A says, I have $500,000 invested. Person B says, my investments generate approximately $2,000 per month. Who feels more confident? Usually person B, because income feels real. Income pays bills. Income buys groceries. Income pays property taxes. Income creates security. The wealthiest retirees often think in terms of cash flow rather than account balances. Market downturns are inevitable. This may seem unexpected, but one of the best ways to reduce fear is accepting reality. Market declines are a normal part of investing. They have occurred throughout history. They will continue to happen. Periodic corrections are to be expected. Recessions are also part of the economic cycle. Occasional market crashes may occur as well. Retirement plans should not be based on ideal market conditions. Instead, consider the following question: what will I do when markets fall? Not if, but when. Having a plan in place can make market downturns less daunting. You will already know your next steps. A well-defined plan helps turn uncertainty into constructive action. Imagine retiring today. Tomorrow the market falls 30%. Would you panic? Many people would. Now imagine something different. You have several years of living expenses sitting safely in cash, high-interest savings accounts, GICs, treasury bills, or money market funds. Suddenly, the market crash looks different. You don't need to sell anything. You don't need to panic. You simply wait. Time becomes your ally. This is why many successful retirees build cash reserves. Not because cash generates huge returns, but because cash creates peace of mind, and peace of mind is valuable. Your retirement foundation. For Americans, this foundation may include Social Security. For Canadians, it may include CPP and OAS. Some individuals receive pensions. Others benefit from annuities. These guaranteed income streams are often underappreciated. However, they offer significant value. They provide predictability. Each month, income is received regardless of stock market performance. Once you understand how these income sources fit into your overall retirement plan, your concerns often diminish. This is because they recognize an important fact. Their investment portfolio does not need to cover all expenses. It only needs to address any remaining gaps. The secret most millionaires learn. Many assume that wealthy retirees do not worry about money. This is not always the case. Money problems and money fears are not always the same thing. A person can have millions of dollars and still feel financially insecure. In fact, some wealthy individuals spend much of their lives concerned about losing what they have built. They frequently monitor market news. They focus on every downturn. They worry about inflation. They worry about taxes. They worry about healthcare costs. They worry about whether their money will last. The outcome is often unexpected. They may have financial wealth. However, they lack financial peace of mind. Meanwhile, some retirees with much smaller portfolios experience greater peace of mind. They may not be wealthy by traditional standards. They may not own luxury homes. They may not drive expensive vehicles. However, they have a clear understanding of their financial situation. They know exactly how much income comes in every month. They know where it comes from. They know how much they spend. They know what happens if the market falls. They also know what adjustments to make if conditions change. This knowledge provides a sense of control. A sense of control reduces fear. Imagine two retirees. The first has $2 million invested. The second has $600,000 invested. Most would assume the first retiree feels more secure. But what if the millionaire has no spending plan, no strategy for withdrawals, no understanding of how long their savings will last, no plan for major market declines? Each market drop feels alarming. Every headline appears threatening. Each economic forecast increases anxiety. Now consider the second retiree. They understand their retirement income. They have a budget. They have emergency reserves. They know their guaranteed income sources. They understand exactly how their retirement plan works. Which retiree is likely to feel more confident? Often, it is the second retiree. Confidence does not come from portfolio size. It comes from understanding. Money alone does not eliminate fear. Knowledge does. Those who understand their finances often feel wealthier than those with larger account balances. They know what they have, what they need, and that they have a plan. This is a key to a successful retirement. The goal is not simply to accumulate more wealth. The goal is to reach a point where money no longer controls your emotions or decisions, where market headlines do not dictate your mood, and market declines do not feel like personal emergencies, and your financial decisions are guided by facts rather than fear. Knowledge creates confidence. Confidence reduces anxiety. When fear no longer controls your decisions, you achieve a level of financial freedom that extends beyond dollars and cents. True wealth is not measured solely by portfolio size. It is measured by the peace of mind your portfolio provides. If 67% of people fear running out of money more than death, this highlights a significant concern. The issue is not simply a lack of money. The real challenge is a lack of clarity. Uncertainty fuels fear. Planning builds confidence. The solution is not necessarily to become wealthy. The solution lies in understanding your financial situation. Be aware of your income sources. Track your expenses. Understand the impact of a downturn. Have a clear financial plan. If you found this video valuable, please consider subscribing to The Illiterate Investor. Here, we do not pursue financial trends. We focus on financial understanding. We prioritize building wealth, protecting capital, and creating financial freedom through simple, informed decisions. One habit, one investment, one step at a time.